Hello, accounting students. We are walking through a problem from this chapter to demonstrate how to post journal entries and transactions in the General Journal. Alright, for this problem, the Mead Company uses a perpetual inventory system and engaged in the following transactions during the month of May. Alright, as you see, there's a list of transactions May 1st through May 27th. And our requirement is to record the transactions in the General Journal. Alright, for this example, we'll be doing this in Excel. So I'm going to flip over to Excel, where I have already formatted the problem, and this is how you would too. You would put the date, account, description, debit and credit columns on a spreadsheet just like this. And you can put the dates in just like that, okay? All right, and so May 1 made cash sales of $6,300. The cost of the inventory was $3,700, okay? So, all right, actually, I'm going to delete these dates because we need the room. All right. We'll clear those contents. There we go. Alright, so on May 1st, we have cash sales of $6,300. Alright, so cash. And so cash is an asset, and it's increased, so that's a debit. When we increase an asset, it's a debit. So $6,300. Okay? And then the cost of the inventory was $3,700. Alright? And so then, on the same date, we have two parts to every transaction, right? So we have sales, because it was a sale, and sales are a credit for $6,300. All right, and then the problem says that the cost of the inventory was $3,700. And so, if we sold stuff, we don't have it anymore, right? So we have to get rid of it. Okay, so we have cost of goods sold, which is an expense. Okay. All right, a little bit. All right, and that's going to be a debit of $3,700. And then we have inventory because we sold it. We don't have it anymore. And the credit to inventory is $3,700. So, as we know, debits make assets go up, and debits also make expense go up. Credits make sales go up, and credits actually reduce assets. Okay? So, we collected $6,300 in cash. We debit cash. We record the sale with a credit to sales. Okay. I'll put balance sheet account right here so you'll see it. And this is income statement. Alright, and this is expense on the income statement. Alright, and this is balance sheet. Alright, and so you can see that if we sold it for $6,300 and it cost us $3,700, we made approximately, well actually we made exactly $2,600 on this sale. Okay, we don't need that for this problem, but that's the effect. Okay, now the next journal entry, May 5th, purchased $2,000 of inventory on credit. All right, we have inventory and on credit. All right, so inventory is going up on the balance sheet for $2,000. And we're using credit, right? So that means we're not paying cash. So it's going to be accounts payable on account that we don't have any money to pay it. Or we're choosing not to pay it with money, so we're using a payable on credit. And so liabilities are increased with a credit. Assets are increased with a debit. So we have increased our asset and we have increased our liability. Okay? Go ahead and $sign that. Alright, the next one. Made credit sales of $3,300. Alright, and the cost of the inventory sold was $1,900. Alright, on May 9th. Made credit sales of $3,300, so we have accounts receivable because we haven't gotten the cash yet. And then we have sales. Okay, accounts receivable is an asset, and it's going to go up $3,300. And we have credit sales, $3,300. All right, and accounts receivable is an asset on the balance sheet. And sales, of course, is income statement. Okay? All right, and you notice that our debits right here are $15,300, and our credits are also $15,300. So our debits are equaling our credits. The next transaction, May 13th, paid sales salaries of $900 and office salaries of $600. So we paid them, right? So we have sales, salary, expense, income statement. Then we have office, salary, expense on the income statement. And then we have, and we paid it, let's see, we actually paid it. So we paid it in cash. Alright, and so we have cash. Okay. Our sales salary expense was $900. Our office salary expense was $600. And our reduction in cash, which is on the balance sheet, I'll put that on there, is the sum of $900 and $600. So instead of doing some math on a calculator, I'm going to use Excel to do my adding for me. So I have equals sum, open parentheses, and then highlight those two cells, close parentheses, and I have 1,500. Okay. And that's that entry. That was May 13th. May 14th, paid for the May 5th purchases. Alright, so we paid those May 5th purchases. Alright, May 14th. So we have accounts payable. So we're getting rid of the payable by paying it off. Accounts payable, $2,000. Cash, $2,000. So we paid it. So what we've done is we've paid off the payable. So the payable right there, those two payable, so those come off. So we don't owe it anymore because we're paying it. And our cash is reduced by $2,000. Okay. I'm going to put a border here. Let's see. There we go. Well, it's not as thick as I wanted it, but it's okay. And then we'll format it. All right. Now, May 18th, purchase sales equipment costing $8,000. All right, May 18th. So, equipment for $8,000. And then, and we made a down payment of $2,000 and agreed to pay the balance in 60 days. So that means we paid in cash $2,000. All right. And then we have accounts payable or note payable. It's a liability account. On the balance sheet for $6,000. Okay? And now let's go back. This is liability on balance sheet. This is asset on balance sheet. Equipment is an asset on the balance sheet. Cash, of course, is an asset on the balance sheet. All right, and so our journal entry balances. All right, the next one, May 21st, we have purchased $600 of inventory for cash. All right, so inventory $600. Cash, $600. All right, remember, assets are increased with debits. So we're increasing our inventory with a debit. And we're reducing cash with a credit. There we go. Then, the last entry is May 27th. Sold land that had originally cost $1,900 for $2,600. So, we got cash. Sold land for $2,600, so we got cash of $2,600. And now we're selling the land, so we don't have the land anymore. That's a credit for original cost of $19,000. And then, so we have a difference there, right? We have a difference between $1,900 and $2,600. So that's the gain on sale of land. And that's going to be the difference between them, all right? And then what we can do, we can check ourselves. We can add up this entire column. All right, all the debits equal $30,000, and all the credits equal $30,000. So we're in balance. So the debits have to equal the credits, okay? And so that is how we journalize those transactions. And then next time, I will show you how to use these on T accounts and have a running balance of whatever is in these accounts. Because we see we increase cash, and then we decrease cash, and then we decrease cash some more, and some more, so we can use a T account to keep track of our cash balance. Okay, and it's kind of like this. Cash. So we had increases in cash. That one. Okay. that looks like are only, alright, we have a cash increase there. Okay, so cash went up by $8,900. And now we'll see cash went down. Right there. Right there. Right there. Right there. Okay. And then cash went down by $6,100. Okay. And so our total cash for the month is $2,100. And that's what a T account does. It'll show you how each account works. So that's cash receipts. And this is cash paid. Okay? And that's how it works. Anyway, thank you for taking this course. We'll be walking through more examples of the homework problems. But this is a very good beginning homework problem for you to understand the debits and the credits. Just remember that debits increase assets and it also increases expenses. Credits increase liabilities and they increase revenue. You just have to memorize it. Follow that formula and you'll be just fine. And always make sure that your debits equal your credits. Thank you.